Business Finance, Chapter 9. In Chapter 9, we continue our discussion of capital budgeting analysis, but we move on from the calculations of the payback and net present value and talk about how we find the cash flows that we use in those calculations in the first place. So first, we focus on relevant cash flows. So these are the cash flows that happen only if the project is accepted. They're also called incremental cash flows. The principle, the standalone principle, is what allows us to think about these cash flows in isolation from the entire firm's cash flows. So we only focus on the relevant or incremental cash flows when we're looking at budgeting, capital budgeting decisions. So when we're trying to decide what the incremental cash flows are, we need to consider several things. So this is the cash flow with the project versus the cash flow without the project. We don't use sunk costs. So sunk costs are costs that have already occurred that we can't change or we're contracted to pay. So these are costs that taking on the project will not affect. They're sunk, already gone. Opportunity costs are costs that we give up. So that's the opportunity given up when you make one decision over another. So if I decide to launch a new product, product A, my opportunity cost is that I can't launch product B because I only have so much space and market share and opportunity to move into a new thing. The side effects of taking on the investment. For example, if I create a new product and I launch a new product into the marketplace, how is that going to affect the sales of my other products? If launching a new product onto the market means that I sell less of my older products, that's called erosion. That is a side effect of that decision that I made to launch a new product. Any networking capital that I have to promise as part of this project. So remember the components of networking capital. So our current assets and our current liabilities. Do I have to maintain a specific amount of inventory in order to take on this new project? Do I need to have a certain amount of cash available? Do I have to take on a new payables in new labor? Do I have, and so those kind of devotions. So what additional networking capital does this project require? We do not include the financing costs. So financing costs from interest payments, namely, are the ones that we would not include as part of our relevant cash flows for capital budgeting. And then our tax effects. So how much are our cash flows after we would pay taxes? We have to recognize that our taxes are a cash outflow. We also recognize the tax effects of depreciation. That's called the depreciation tax shield. So how much of our tax income how much do we save in paying on taxes because we have depreciation on an item? We start by making pro forma statements to project the future operations. So pro forma are projected financial statements. So for example, these would be the financial statements made from a budget. So they're in the future, pro forma. We make a income statement or a pro forma income statement where we put all of the various costs and revenues for the project, and that helps us come to our operating cash flow. So remember from chapter 1 and 2 that operating cash flow equals earnings before income and taxes plus depreciation minus taxes. Or it's just net income plus depreciation if there's no interest expense or tax expense. Our cash flow from assets is the operating cash flows minus the net capital spending minus any change in net working capital. So for this example, we're creating a product for the market that is a shark attractant, and it comes in a spray can. We're estimating that we're going to sell 50,000 cans, that the project is going to have a 3-year useful life, and then people are going to move on to another novelty product. The sales per can, the variable cost per can, the total fixed cost associated with the product, the initial cost, how we depreciate it, so we can see it's 100% depreciated, so there's zero salvage value, our requirements for net working capital, our tax rate, and then the company's cost of capital. Often, the cost of capital becomes the required rate of return. So we create this pro forma income statement. We have sales, 50,000 units at $4 a unit, our variable cost per unit, that gives us our gross profit. And then we take our fixed costs and our straight line depreciation, giving us the earnings before income and taxes and our 21% tax rate, which gives us our net income. We then can look at each year side by side for our projected capital requirements. So this is our pro forma balance sheet. So we need 20,000 in net working capital, and we have 90,000 in fixed assets in the first year. In the second year, those fixed assets have dropped to 60,000, and that is because of the $30,000 depreciation expense that we took it. So the fixed assets decline every year by the amount of the depreciation expense. Now we can project our total cash flows. So the net working capital is required at the beginning of the project and then is recovered in the final year of the project. So in the beginning of the project, we have net working capital that we're devoting to this project of 20,000. And we have the initial cost, which is 90,000. We then have incoming cash flows every year for 3 years of $51,780. We then recover our net working capital in year 3. If we also sell the equipment at the end of year 3, that would also be a cash inflow that we needed to consider. Our operating cash flows then were calculated by taking the earnings before income and taxes plus depreciation minus taxes. If we're using a financial calculator or a scientific calculator, this is how we would enter the information in order to calculate the net present value and the internal rate of return for this project. When we're using Excel, we can calculate the net present value and the internal rate of return on this project. Then we need to decide, should we accept or reject this project? Given what we know about capital budgeting decisions after Chapter 8, we know that if the net present value is positive, that means that it is an acceptable project. We can also use a tax shield approach to calculating the operating cash flows. So if we take sales minus costs times 1 minus the tax shield plus depreciation, or 1 minus our tax plus the depreciation tax shield. The depreciation tax shield is the depreciation expense times our tax rate. We will get the same exact result as we get if we take earnings before income and taxes plus depreciation minus taxes. This is useful when our incremental cash flows are the purchase of equipment and the associated depreciation tax shield, such as if we're making a decision between two different machines. We might not necessarily have the additional sales like we do if we're looking at a new product launch. So looking at how the depreciation tax shield contributes to the operating cash flows. When we're calculating changes in net working capital, we have GAAP requirements. So we have US GAAP, which requires that sales are recorded when made, not when cash is received, and that cost of goods sold are recorded when the corresponding sales are made, whether suppliers have been paid yet or not. So we can look at the cash in equals sales minus any change in accounts receivable, and cash out is our cost of goods sold minus any change in accounts payable. So we can calculate our changes in net working capital that way. We're looking at if we buy inventory or materials to support sales before we collect cash from those sales. So when we're making changes in net working capital every year based on our cash flows, it's because we're taking into account the accrual accounting for sales that GAAP requires. Depreciation is a non-cash expense. It's only relevant to our information because of the tax shield that it offers. Remember, our depreciation tax shield is our depreciation expense times our marginal tax rate. We can use the schedule required by the IRS for tax purposes if we are using, we'll move to the next slide. So we can either use straight line depreciation, which we know is the initial cost minus the salvage value divided by the number of years in the useful life. Or we can use MAKERS, which is the accelerated depreciation schedule provided by the IRS. If we are using the accelerated MAKERS tax depreciation, then we depreciate to zero. The useful life or the depreciation period equals the class of our equipment. So we might have 5-year equipment or 7-year equipment. We use a half-year convention, so it depends on whether we've purchased the equipment before January 1st or after January 1st. And we multiply the percentage in a table by the initial cost of the equipment. So if you're using straight line depreciation, you calculate that yourself. If you are using the tax rates provided by the IRS for MAKERS depreciation, you use the tables provided by the IRS. Those tables are also provided in your textbook that give you information about what kind of class your equipment is scheduled at and what percentage you use for that class of depreciation. Our after-tax salvage value, so this is if our salvage value or what we sell the item for is different from the book value of the asset. There's a tax effect for that. So we don't pay tax on the entire revenue that we receive from selling a used piece of equipment, but there is a tax effect on the difference between the book value and what we sold that for. So we know that the book value of our equipment is the initial cost of the equipment minus the accumulated depreciation. Our after-tax salvage is the salvage value minus the tax rate times the salvage minus the book value. So let's look at an example for that. So the tax effect on salvage, we have the selling price minus the book value times our corporate tax rate. So the next couple of slides have an example of that. So suppose we purchased a car for $35,000. A car is a 5-year property for maker's tax, and we have a marginal tax rate of 21%. We use the maker's depreciation schedule to depreciate that car over its useful life. This is a 5-year asset using the half-year convention, so we have 6 years. So when we sell this, if we sell it at the end of year 5 for $8,750, then we have a difference of the sale price minus our book value that we have to pay taxes on. If we sold it at year 2 for $15,000, where it was less than our book rate, we would also have a tax benefit from that. We'll look at this example throughout the rest of the slideshow, and I'm going to do that on the next video.